people were deploying chargers where they were easiest, not where they were best suited from a utilization perspective, or also where it would intuitively make sense. Maybe you know the city and you say, oh, this is a popular mall or commercial center, so this is likely to be a great charging location. Fast forward a couple years, and essentially we look back and we said, okay, how are those sites doing? And it turns out they didn't really map to intuition well. The sites that we thought would be great performers ended up not being great performers in many cases, and the sites that we thought would be poor performers actually ended up a lot better.
Welcome to In Between Charges, the perfect podcast to listen to while waiting for your EV to charge. My name is Kevin Spangenberg, and I am joined, as always, by my co-host, Mike Hawks. Mike, how are we doing today?
Doing good, thanks. Doing good. It is flu season in Copenhagen and maybe a few other countries as well. I think I had my bout of it a few weeks ago, but we are recording today from our in-house flu jab center, of which I think you've already taken. And I think when it next comes around, I'll have to step back in. There was a big queue of people to do it, but feeling good, feeling fresh.
Good. Yeah, I am feeling good. My left arm hurts, but don't really know how to segue from flu shots to DC charging, but we're going to try that. So, Mike, our industry is, I wouldn't say in flux right now, but there's a kind of a shaking out going on. When I was actually at Move America, they were there talking about surviving the shakeout right now, because a lot of companies have invested a lot of money in putting in charging infrastructure, especially DC charging infrastructure. It's quite expensive. They are not cheap endeavors. So if you are investing and putting in chargers right now, you really need these things to be used quite a bit to start paying back your investors. Maybe you've got some private capital, maybe you took a bank loan, but we also know that not all sites are created equal. I know you've been doing a fair bit of research into the performance on the Monta platform recently. So today, that is the kind of topic that we want to discuss is DC charging, site selection, utilization, and everything that goes into building a successful charging business. So we are very excited to be joined by Rohan Puri from Stable Auto, who knows more about this topic and has more data on this topic than probably just about anybody else. Stable Auto provides data-driven site selection that is trusted by many of the largest American CPOs to deploy thousands of chargers across the country, and then also provides pricing recommendations and other tools to help these operators ensure the revenue of the chargers is maximized on a daily, weekly, monthly basis. So we'll dive into all those ways that they're doing just that for operators. But Rohan, first, welcome to the show.
Thank you for having me. It's great to be here. What a great segue from flus to DC fast charging to now stable. So thank you.
There we go. It doesn't quite follow a red thread, but we're going to make this work and make it cohesive. So, Rohan, you are a founder. So whenever we have a founder on the show, we want to talk about their founder journey. You founded Stable Auto back in 2017, when it was obviously a very different time for EV charging. That's 8 years ago. EV charging industry wasn't even a twinkle in my eye back then. Probably not for you either, Mike. Tell us a little bit about your founding story and what Stable Auto is trying to solve for in the EV charging industry.
Yeah, it's been a wild journey, but Stable actually, believe it or not, we're currently a software company, but we started off as a hardware company. So we actually used to build robotically operated EV charging stations. So if you remember back in the day, the Tesla charging snake arm that would, wander up into the car, automatically charge the vehicles. We essentially built that equivalent, but for autonomous electric fleets. And so that's how we actually got our start. It was just a few of us, 3 of us in a garage. This is the peak of self-driving and autonomy, and then we have the trough of disillusionment, and now we're back. Now we have real self-driving fleets operating for real, and I think actually the EV charging is likely going to see that exact same trajectory. But with self-driving, at the time, there were a bunch of fleets, fully electric fleets operating in cities like San Francisco, and they would need small top-offs throughout the day where they would get their charge, do some recalibration, dump some data off, those kinds of tasks repeatedly throughout the day to keep them operational. So the need for those fleets were a way to charge. And so we had an off-the-shelf robotic arm that could charge a variety of different makes and models of vehicles. And we actually deployed the world's first robotically operated charging facility in the Mission in San Francisco alongside Electrify America. Electrify America being one of the largest CPOs here in the United States. Now, the problem was we deployed that in February 2020, which is perfect timing to operate a charging facility.
Speaking of flu shots.
That's the segue. I knew it would come back.
I was going to say it's perfect time to operate a charging facility right before a pandemic, and SF was one of the first cities to close. And obviously, Uber, Lyft, rideshare fleets had much bigger problems on their hands with that. But in doing so, actually deploying with Electrify America, the question came up again, okay, where are we going to start deploying the next facility? And how are we going to get the best balance of utilization from these self-driving fleets, but also if we want to open up to the public, where should that go? And I think we were surprised to see the lack of significant amount of analysis and data science going into infrastructure decisions. By and large, at that time, this is 2020 timeframe, people were deploying chargers where they were easiest, not where they were best suited from a utilization perspective. It's where is their power? Where can we get permits? Do we know the landlord? And that was about it. So that's what launched us on our trajectory into what we do today, which is essentially a suite of software that helps you optimize the profitability of your charging network by choosing good locations and operating those assets well.
Wow. I did not know you started in the hardware space. That's very cool. So let's dive right into it. I first heard about Stable, I think we met a couple of years ago at an event in Houston, Texas. And I was like, wow, I enjoyed, chatting with you about all this. So, Monta provides the charge point management system that a CPO is using to run their network. Stable Auto comes before in this process. So ideally, we are working with a CPO that maybe has used Stable Auto to select highly profitable sites that they are then running and hopefully optimizing with Monta software. But these are expensive endeavors, right? Building out a DC site is not cheap. And it's a big decision that they need to get right. Now, you said maybe a few years ago, there was a little bit more convenience involved in the decision. Maybe there's funds available, they're putting them in, there's other factors that maybe contributed to where chargers ended up. But now there's really a focus on utilization. Now, those chargers that they put in 3-4 years ago are probably still there. You don't really rip these things out. Maybe in some cases you do. But what types of factors and variables is Stable Auto taking into consideration when you're trying to predict site utilization and really guide these CPOs that need to be ensuring that every dollar that they're spending right now is optimized?
Yeah, it's a great question. Well, let me put it this way. We used to put chargers in places where they were most convenient, just like you mentioned, or also where it would intuitively make sense. Maybe you know the city and you say, oh, this is a popular mall or commercial center, so this is likely to be a great charging location. Fast forward a couple years and we saw, essentially, we look back and we said, okay, how are those sites doing? And it turns out they didn't really map to intuition well. The sites that we thought would be great performers ended up not being great performers in many cases. Not in all, of course, but in many cases. And the sites that we thought would be poor performers actually ended up a lot better. The challenge was it wasn't really mapping to intuition. In fact, if it could map to intuition, there would be no need for Stable's products in general. Like the whole reason that we have customers is that a bunch of people have been burnt by spending for a DC fast charging site. They're spending around $750,000 to $1 million, pretty much minimum every single time. It takes 6 to 18 months to install the damn thing, get the permits and everything. So it's a significant investment. And then to do all that work and to see that your utilization is, 2 to 3%, a few sessions a day is just never going to pay back even on the 10-year asset lifetime. So the point is it doesn't match intuition. So we have to use real data to then understand what does map to utilization. Is utilization actually sort of predictable or at least underwritable, like understanding what the floor of utilization might be? So what we do is we take real utilization rates. This is from publicly funded chargers, publicly available data, and customer provided data. We take real utilization rates of chargers across the country, and we correlate it with a bunch of other data sets that we look at. So we see how is utilization correlated with traffic? How is it correlated with EV penetration and demographics and the amenities that are nearby and the average driving distance and where are those vehicles coming from? And it turns out it's not necessarily one feature that guides utilization. Obviously, generally, if there are EVs nearby, you're likely to see better utilization. But it depends, right? There are lots of sites that have great EV penetration rates nearby. But guess what? Everyone charges at home and there's lots of competition, so you're never going to see that much utilization at that site. Other places we've seen great utilization rates, great EV penetration, great traffic, but the average trip distance is less than 5 miles a day. So there's just no need to use a public DC fast charger. It's not just one data set. It's a combination of data sets and weights on each of those data sets that yields the best results. And so we have to look at a combination of those things and get a predictive model. Now, we're trying to predict the future, right? So we're never going to be right. But we've been able to prove that it is predictable within a certain range. And that will give business, CPOs and even their investors some baseline confidence in the value of a portfolio before they deploy. Before it was sort of like intuition, finger in the air. I'm sure many of the people listening who are deploying charging infrastructure have had to go into an Excel model and create a 10-year financial pro forma, and they have to take utilization year one and somehow grow it year over year.
10%.
And what most people are doing is saying, I assume, 5% growth year over year, right? It's sort of random. We're just trying to bring a lot more precision into that so you have a lot more confidence in that investment.
Okay, I think it's a a really interesting model. And I guess when we're coming into this, location is always the biggest factor that CPOs quote as some of their darling sites, their kind of favorite sites. And I guess when you're doing site selection around, you're talking about lots of different factors, demographics, EV adoption, how much are people driving, availability of private driveways, et cetera, et cetera. Do you also take a look at site performance and revenue strategies as well? So I guess you're thinking before the charger goes in the ground as well as after, because for an operator, as you say, there are many different levers that they can pull. But I guess still the biggest predictor is site. So as long as they can win the best site, that will put them in the best stead to be able to guarantee at least some sort of base utilization. But then what happens after that? You know, as we know, and a lot of data that we see, if you have a poor first experience, the amount of revenue that you could get from a repeat driver drops by 60%. That will just go to the charge point nearby. That might be a factor of a more mature market or area where you can just literally cross the highway and go to another charge point. It's not always going to be the case. What are some of those levers that you've seen pulled that have really turned the needle on performance or utilization?
We focus primarily on DC fast charging. The closest equivalent that we have today for DC fast charging is gas fueling, right? So the way that we think about it, and we help our customers think about it, is treat it like a commodity. Treat it like you have some standard hardware, and just like in fueling, do you really care which gas pump you're fueling at? No. Do you care what brand of gas station you're fueling at? Not really. I mean, it comes down to location and price, and maybe a little bit of the amenities, like what's the convenience store that's attached to it as well. That's really all it comes down to. And price matters to an extent. You probably won't drive 10 minutes for 1 cent off your charge. But maybe if it's significant, like a Costco, or Walmart or something with significant price difference, you may say, okay, I'll charge at that place versus the other. So that's why we really focus customers on those fundamentals. Choose strong locations, good amenities, and price the infrastructure well. The way we see it is that as vehicles become more and more autonomous, right? Getting back to our origin story a little bit here, but as they help guide, do a lot of the driving and decision making for you, they will probably, I'm guessing here, but I'd assume it's probably just going to choose for you the most convenient, best price charger with the amenities that you tend to prefer. And the driver is really just, saying accept or reject that suggestion, right? So that it just becomes an algorithm. So the most convenient location, the best prices will tend to win out overall. So that's why we look at location. Location certainly matters. And we help customers steer away from common tropes. In the United States, this might not be true in other markets, but one of the things we see is customers veer away from deploying chargers when there's already a competitor nearby. They don't want to deploy chargers if Tesla's already there or EVgo's already there. But actually right now in the United States, we observe the opposite effect that, when a competitor deploys across the street from one of your locations, both you and the competitor benefit from better utilization than you otherwise would have had. We don't know precisely why. We can guess maybe there's alternatives, there's plenty of chargers. If it breaks, you can go to another one, what have you. But it becomes more attractive, like we've seen in fast food chains and car dealerships and things like that, to have more infrastructure in the same place. So that's why data is so important, because you might think intuitively, I'm thinking like gas stations and it's going to eat at my demand. In a fully saturated market, for sure, but not now. And you might be, missing out on really great opportunities. So on the pre-deployment phase, location matters a lot. On the post-deployment phase, you're not just stuck with the site. So if you say you chose a terrible site, of course, if you're getting like 1 session a day, there's not much Stable can do for you, to be honest, right? It sort of is what it is. But, if some of that is related to reliability, I know that's what Manta helps signal, right? And customer loyalty. Maybe that's why. Maybe it started at really high utilization and it dropped off over time. That's an indication that it's reliability concerns. The second is pricing, right? We actually help customers dynamically and adaptively price their charging infrastructure to make weekly updates to their pricing based on competition nearby, predicted demand next week. Say it's the Christmas holiday and we expect a big surge in usage. And last year we had a lot of queuing. That's a perfect time to consider raising your prices or at least changing their time of use rates. So it doesn't mean that just because you deployed an asset, it can't make money. It just means that the game has changed a little bit and you're optimizing a little bit on this margin side of how am I managing my demand caps and energy costs on one side and adjusting those to what I predict my demand will be, and how do I manage my pricing? But the core of everything we do is predicting demand. If you can predict demand well, you can choose better locations. And if you can predict demand over time, you can choose better prices and energy caps.
was having a conversation with a public CPO back here in Europe and was asking, right, if he was to picture his favorite sites and controlled for location, what is it that makes a difference? And his answer was, I have absolutely no idea. What makes that difference between, even though they're at a baseline, one's doing better, one is not, there's a lack of performance data and predictability out there that will help them to make better choices.
You mentioned some of the intuition a few years ago in the US was maybe incorrect, right? So people said, I'm going to put it in this part of town or this part of the city that I think, this is close to a gas station or something. Maybe that's the right spot. There's a kind of urban-rural divide, which I kind of would maybe like to hear what you're kind of seeing and reading on that front. But you said some people have been kind of surprised, right? Or maybe you've been surprised and other CPOs have been surprised by outperformance at some sites and underperformance at different sites. So could you discuss like some of the kind of surprises that you've encountered in the data where you're like, wow, that's really what it's showing is that utilization is high here and low here, and why it's not as simple as put it near the freeway, put it near the gas station?
Yeah, one of those is the competition thing, right? At least in the US, don't worry so much about competition. You'd be surprised what type of utilization. Another surprising factor, it's not really location-based, but hardware matters. It probably is a function of reliability. But we see that certain makes and models of chargers, when controlling even for like price and power level of the chargers, outperform. Like Tesla chargers, I remember reviewing a couple sites recently where we looked at co-located Tesla infrastructure, and then there was a few other manufacturers that were right there nearby, right? Essentially the same speed and price. I believe it was maybe ABB and Alpatronic or SK Signet. That just by virtue of using Tesla's hardware and being on the Tesla's network, those chargers saw about 2x the utilization. And everything else was roughly the same. Price was roughly the same, location roughly the same, power level roughly the same. So people prefer that charging experience. But I think in terms of like the rural versus urban divide, this can be surprising for folks as well. Obviously, like rural locations tend to underperform in general. It really does depend. Like, what do you mean by rural? If it's a major highway, rest stop, travel stop, there's groups like Apple Green who are doing great, right? Who are really seeing some advantages. Love's Trucking, Pilot Flying J, right? There are great travel stops that are rural that tend to see great utilization rates as long as the traffic you're feeding through there is coming from high EV penetration rates, zones, and trip distance is fine, and reliability is there, right? You got to get the fundamentals right. But I think on the urban side, what's surprising to folks is this competitive effect is particularly important when it comes to the rideshare segment. So EVgo, for example, has been pretty public about the influence of rideshare on their kilowatt hours dispensed, right? They've published reports about it being quite significant. Big part of their kilowatt hours is coming from the rideshare segment. And it turns out that the rideshare drivers are particularly sensitive to things like the amenities. Of course, it makes sense, right? They want a bathroom, they want lunch right nearby the site. But they're also much more price sensitive. And so they care a lot or optimize a lot more for price, and more than a typical driver would. And this is, again, US. And so you might think that like in urban environments, you're trying to get public use, but actually you may be, depending on the rideshare penetration, you may be optimizing for there. The last thing that we see that I think is really interesting is that the port count really matters. So sites with small numbers of ports, of low charger ports, I think everyone would understand intuitively makes sense. It's probably less attractive. It's the same thing as that competitive effect. There are fewer alternatives, slower charging. And even though most cars don't charge at the fully rated speed of the charger, right, people just want the fastest possible charge. The flip side of that, though, is that larger charging sites tend to attract more traffic up until a point. So right now, that point of diminishing returns we're observing in the data is around 12 or so ports. We start to see dropping off on a sessions per port basis. Again, it's highly dependent. If an airport location, a mega hub, is very different from a typical urban location. But there's a point of diminishing returns where that additional capital is not yielding additional sessions. Some strategies, some CPOs are taking the strategy of building out capacity for 20 ports, but only putting in 10 to 12, maybe even 8 to start.
So let's talk about what good looks like. In a site with 2 to 4 ports, we'll have, a very different measure of success maybe than a site that has 12 to 14 ports, right? Because those are maybe very different investments there, right? So you're like looking at a different payback period. We actually spoke, Casper and a number of us spoke with quite a few CPOs earlier in this year to work on a DC utilization white paper. And we arrived at the kilowatt hours per port per day as our metric instead of a utilization percentage. This is for basically pure play CPOs, right? Where it's kind of like, this is your business, this is the game. And we found Casper, I wasn't actually involved in the exact science of this report or anything, but was say basically over 220 kilowatt hours per port per day is a top performer. So that's now what we put in there as a benchmark for our CPOs. Over 150 kilowatt hour per port per day is very good performance. 50 to 150 is fine, good. Obviously closer to 150 is good. 50 is fine. Less than 50, not doing very great.
Yeah, like one session a day.
One session a day. Average session is what, 32, 33 kilowatt hours? It kind of depends, right? But in that range. How does that sound to your ears? What do you guys consider good versus not good performance?
Yeah, I mean, in general, I think that those are great guidelines from a kilowatt hour perspective of energy dispensed. But again, it sort of depends on the customer, like who is the CPO. If the CPO is a site host, then their metrics are a little bit different. They care maybe more about sessions, and the kilowatt hours is really just a break-even point. The top two things we always try to focus on is, the first is IRR, right, or ROI. It counts for the CapEx costs and the payback period, and even things like depreciation, escalation of energy rates, et cetera. A CPO is managing an asset, and an asset manager is trying to hit an IRR target to pay back the initial investment, right, to help fund future sites or to back fund their investors. And so IRR and ROI is ultimately what matters and considers the CapEx cost and the energy cost as well. Now, that's harder because, it's hard to do an apples to apples comparison because, CapEx costs can vary considerably across sites. So the next best thing is net margin, right? Net operating margin. Again, thinking just from the lens of a CPO, sure, it's great to have 220 kilowatt hours per port per day. That is a top performer in terms of traffic to your location. But if your hands are tied on your utility rates, or the peak demand is so high and you're having to throttle it all the time just to make sure, you can keep that margin, that gives you a better picture of the full story. Is we like net margin because not only does it account for the kilowatt hours, but it accounts for the price. It also accounts for the energy and how your demand management might be, your load management might be. But of course, like as a high level metric, utilization, there's different ways to do it. Kilowatt hours, I think, is the cleanest, most scientific. Utilization by time isn't perfect, but it can give you better apples to apples across different locations. Session count is probably a good one too. It just gives you a number of customers. The problem with all of these is they each have trade-offs. So you kind of have to report them all to get the fullest picture. Yeah. Session count is good, but if all those sessions are tiny, it's misleading. Utilization by time is good, but if your charges are slow, it's misleading. So generally, like 15% utilization is roughly the mark, right, in the US market at least. But it obviously is so dependent. Like, is that, that's by time. So it depends on your chargers and your utility rates. So we focus on, and in our tools, we let you generate a financial performance to get you to IRR, right? That's the goal, is IRR and margin. What is your margin expectation? Like, what number of sessions do you have to believe for this charger to pay for itself in X number of years? And if that seems crazy, right, then this is not a site to go after.
So we talk about return on investment. How long is it until this charge point starts to essentially pay itself back? A phenomenon that we see for a lot of charge point operators is also a maturity curve until you hit repeatable demand. And that can take 12, 24, in some cases 36 months, where you build up a reputation or a knowledge or a captive group of customers who are like, yeah, okay, this is the site's here. You're discovering it. This is my spot. It could also be, I haven't thought about getting it onto Google Maps right now. Maps is starting to offer sponsored places for charge points. We took a look at some of the sites and, Mercedes is already purchasing spots, so it shoots right up to the top. And you get that. Is that something that you also see when you're working with sites, that they have this maturity curve?
We do see sort of a ramp up effect, like for people to be aware of the site takes some time, right? Nobody knows the site exists. There is a degree of loyalty around sites. So like members tend to retain, like if they're paying a subscription rate on charging locations, they tend to be, more loyal to those charging locations. So there's definitely a ramp up that we see. That's the extent of it today. And it may just be a factor of like, there just aren't that many chargers. We're still just trying to like get our feet under us.
Tell us a little bit about like Stable Auto then, kind of like where you're getting traction. When we met a couple years ago, you mentioned, sometimes it's like investment funds are actually a purchaser of the Stable Auto product, product portfolio, right? Because as these investors are, slowly but surely kind of eyeing this up and thinking, well, maybe there's something there. And if we put some money in there, this could be something valuable. But obviously, you also work with CPOs as well. What's the kind of Stable Auto pitch, and how do you kind of like, do they hold you accountable, I guess, right? When they come back and say, Rohan, thank you so much. Those 5 sites you recommended have just been out of this world, and tell us 5 more because we need to keep doing that.
Yeah, it's interesting. We're seeing more and more, even in the last 3 to 6 months, a significant uptick in sort of more financially oriented PE groups, asset management groups, infrastructure funds, banks issuing loans, banks valuing collateral, EV chargers as a collateral against a loan, like a securitized asset, which is a really promising sign. Like PE doesn't roll into EV charging for, climate, right? They roll in because there's money to be made. And so to me, that's a really strong value proposition. Now these types of groups are used to paying for sort of external diligence, right? A third party group to give their opinion or their thoughts on that. And we're a SaaS company. So we, in our tools, while we do come up with predictions and forecasts, they are user defined, right? It depends which address you put in, how many charges did you expect to put at the site, and then you have to make some assumptions about what the feature will be. Do you believe McKinsey's adoption curve or Bloomberg's adoption curve or Deloitte's adoption curve of EVs in the US, right? There's everybody has a different projection, and in Stable you can choose between those projections. The tricky part is of course a prediction. Now against a portfolio of sites, we have done a lot of back tests, and we know that we're quite accurate, right? We know exactly what our bounds are, and we have to report to these types of customers what our uncertainty in our measurement is, when we've been wrong, how far wrong have we been, et cetera. And nobody's expecting perfection, right? It's a very hard problem to understand, and it could flip entirely in a new administration, right? It changes every 4 years potentially here. So they're not really looking for that so much as they're looking for the most bearish view possible, right? In the worst case scenario, what type of utilization can I expect? And they may even haircut that. Right now, the only alternative is put your finger in the air and guess. Try to look for a similar or nearby site that's there's some public data for. And those aren't great proxies because your site's different. It has different amenities, it's a different number of chargers. It has, there's quite some differences around it. But to me, this is one of the most interesting segments because they're not typically the ones doing the construction or the install or even the operations. They're the ones who are making the investment decision. So we go in front of investment committees. They tear our models apart, right? They ask all sorts of questions about our assumptions, and we're an open book. We we have a no black boxes policy at Stable. Here's how our models work. Obviously, there are assumptions. Obviously, we're wrong, right? There are times where we're definitely wrong. But we've definitely spent more time than anyone else on only this problem, which is trying to predict and forecast utilization and demand. And so if there's anyone who's going to be close, it's us. And just go look at our track record, right? We'll just show you how we've been right or wrong in the past. So you're going to get some confidence in that. So I think that's a really interesting segment. They're typically behind these folks, the typical CPOs. And because we don't sell chargers, we don't sell hardware, we don't sell software for chargers, we don't have a network, we have no incentive to tell you a site's good or bad, right? Whereas, the CPO that is pitching you for your money may have an incentive to say these are great sites, right? And so that's where we come in as this sort of third-party, neutral, Switzerland approach.
Are you then dependent on companies like Monta or the individual CPO to get that data, like the utilization data? So when you go back and say, all right, how the last 12 months go? Where were you at? Was our 12-month projection correct or not correct? Are you then going back to them and saying, what's it look like?
Yeah, and we're even correcting it, right? We'll say, okay, we predicted X, it was X plus whatever, 10%. What does that mean for the rest of my 3-4 years going ahead? Yeah. The point being is, it's an interesting, proposition because if we are wrong in the direction of saying a site was good, but it was ended up not being as good, we get a lot of questions like, why? What happened? Is my price too low? Is my reliability bad? Were you wrong, et cetera? People typically are looking at us at a portfolio view, but when this happens on the site level, we get a lot of questions. If we get wrong the other way, where we predicted lower and it was actually higher, nobody ever says anything. So there's a bias of only when it's lower do we hear about it. And, it's a hard problem. But in every other asset class, there is some sort of model to help you understand what demand will be. For solar, for battery storage, for wind farms, for everything. You do some basic diligence to make sure, is there going to be enough sunlight at this location, before I put a bunch of capital in place? And we're just that. It's same for retail, right? There are retail products out there from folks like Calibrate and what have you that try and position around, like, where do you put your stores and your gas stations? And, it's the same idea. You're trying to predict how many customers are going to show up. What is their approximate energy draw? What's the margin that you can expect before you make this a significant investment? And to your point, we are dependent on platforms like Monta to go back and correct it and make it better, right? Every single day. So we just want the customer to say, okay, here's my actuals. Now let's correct it going forward. They're not expecting perfection, but they want to get better over time.
We've got a couple CPOs in America using Stable, so hopefully we can sign a few more and begin sharing that data with you and hopefully see you maybe wrong on the upside or downside, whatever.
Yeah. That's what people are always happy with that. They're always happy with that.
Right.
Under promise, over deliver.
Yeah.
As a company, when you approach an operator and say, hey, look, I bet we can make you a successful site and we think that it's here, we've modeled the US and we know that there are these 100, 1,500, whatever, 3,000 sites that are really, really hot. If you go after them and you win them and we hit it, then you almost have like a stake in that play as you play a little bit of a closer role with an operator. You say, okay, you make a 30% margin. You don't have a SaaS fee. Instead, you're paying a rate of return.
Yeah, we have gotten that question. We've gotten that request to pay on, success or to pay on margin. And I would love to do that. Don't get me wrong. But as soon as I do that, I lose my neutrality.
Yeah, right.
So now I have a bias towards one network or another.
Yeah, that's true.
And I'm trying to serve everybody, no matter what hardware or software platform they're using, if they're Monta customers or not, right? We want to be able to serve everybody. And some of our customers have multiple platforms under one relationship. There are a few PE roll-ups emerging into the space right now that are acquiring some CPOs and assets that are up for sale. There's some consolidation happening everywhere right now. But, in the US, our tools are being used to diligence those assets, right? To understand what the potential could be, how they perform, benchmark them. So as soon as I own operating, value on a charging station, I lose that neutrality. Yeah. And that's very much a one-way door, right? So we have to be really careful about those.
Yeah, that's really valid. You instantly step into conflicts and then you're like, these sites that I have, they better go.
He's keeping his good ones over there for those guys. Where's the good stuff over here? Damn it. Rohan, American to American here. I was just in Detroit at Move America. Sentiment was okay. Casper was at ICNC in Germany just a few weeks before Move America, right? And he was kind of talking about how everybody's there kind of yeah, things are going well, but actually underneath the surface, everybody's struggling a little bit right now, right? And it's tough to make ends meet. And you've talked about just a little bit ago, maybe have some stranded assets, some sites that aren't doing very well. What's your kind of overall take or on the pulse of the American EV charging sector right now from your vantage point?
It's definitely, we started off the year rough, right? Everybody. The problem was there was just too much uncertainty, right? We didn't know what Trump was going to do. We know there's going to be headwinds, but we didn't know the extent of it. And obviously we had all these, pundits being this is what Trump's going to do to the EV charging market, but nobody really knew. And that's the problem. Uncertainty is the biggest issue facing infrastructure investors, right? They cannot deal with that level of uncertainty. So the problem was we didn't know what was going to happen to NEVI funding. We didn't know what was going to happen to state and federal funding programs out there and incentives. We didn't even truly know what was going to happen to the EV tax credit. We know what he campaigned on and then eliminating that credit, but we didn't know because everything was flipping back and forth over and over. The difference now in the last 3 months or so really is that we have some certainty now. We know the tax credit, the EV tax credit is gone. We know NEVI is back, right? It's mostly back in actually looser guidelines across what NEVI will be. So now you can plan against it. And I think, there are some folks that are really taking advantage of the moment. Groups that are well capitalized are doubling down right now. Fundamentally, if we look at utilization rates before Trump was elected and now, utilization is generally the same or better. EV adoption is still going. Yeah, it might grow a little slower, but EV adoption is still growing. Some of the smaller players may shake out, which means just less competition. If you're well funded, this is the time to buy, right? This is the time where you can maybe pick up some assets for cheap.
Yeah.
And double and triple down and take chargers and leases off people's hands for low cost. We saw Shell is trying to liquidate Volta's business, right? They're trying to figure out how do we, get those off of our hands. There are probably some decent leases there. Now there's lots of other stuff they're tied up into. I don't think anyone believes EVs aren't going to be a thing. It's just, can you convince an investor to? And so the funny thing about investors is there's the investors who all follow the crowd and do what's hot, which is what we saw in 2021, 2022. EV charging was the big hot thing and everyone was raising these mega rounds and equity and whatever. Now we definitely don't see those bandwagon investors, but we see the contrarian investors. The contrarian investors are saying, everyone thinks this industry is a bad industry right now. I actually know that there's nothing fundamentally different here. And this is the time to double down. And so the smartest players, in my opinion, obviously I'm biased, right? But the smartest players, in my opinion, right now are taking advantage of the lull and saying, I know this is nothing. This is a blip on the radar. This is EV's self-driving moment. But fundamentally, we're going to have EVs just like we're having self-driving cars. And there's nothing that's going to stop that. It just might be a different ramp than we expected.
That's good. That's encouraging to hear. Well, then, in that same vein, I'll ask you to put your contrarian investor hat on for our final question.
So if you had 10 million to invest in the EV charging industry right now, where would you put that? Could be anywhere that you started talking about. OEMs, connectivity, Internet of Things, however broad that is. Start a washing machine company and try to run in EV charging. That did actually happen in Europe. But if you had 10 million to invest, where would you put it?
So to me, the biggest opportunity that we talk a lot about but haven't acted on yet, and I think we can act on quickly, is around energy arbitrage. So what does that mean? Right now, one of the biggest problems with EV charging is that we have spikes in demand and we have big demand charges. And so we have all these fancy load management algorithms that try to balance your energy and put them into batteries and things like that. That's also a major problem, mostly for sites that are underutilized, right? The sites that are well utilized don't really have that problem. The challenge is that in managing energy costs, you throttle the charge for your drivers. So drivers see just slower charging, and you have to do it to maintain your margin, which is fair, but drivers have a frustrating experience. What if instead we use price? So what if instead of throttling the charge, we give drivers the option to charge at full speed at one price, half speed at a different price? And you let them choose, but you give them the option with pricing as the main lever of energy arbitrage. So rather than throttling them behind the scenes, you let them do that. Now imagine that same algorithm applied across thousands or millions of chargers, where price is being used to drive decisions on how fast to charge and driving capacity on the grid in one direction or another. So when the grid is overstrained, you raise prices at those times to disincentivize charging, and you sell that capacity back to the grid. And you say, utility, I will try to incentivize less charging right now. In exchange, you pay me for the lack of load. And utilities will pay a lot of money, especially with all the load they're seeing from data centers and AI stuff right now. So I think for EV charging, in my opinion, it's sort of doomed to be a margin game, right? It's going to be this kind of relatively small margin, high volume business like we've seen in fueling. And so the key unlock in EV charging is actually these additional revenue streams. So energy balancing and V2G and arbitrage is one category. The other one I'd love to see unlocked is in-store shopping and loyalty. I don't think anyone has really successfully connected the charging transaction with the shop transaction and said that this charge led to this many new retail sales specifically, right? And I can tie that directly to data. We have to unlock these new revenue streams to make this business successful. So in EV charging, that's where I'd put my bets. Is it's actually more about software and data than it is about anything fancy. It's just get these new revenue streams unlocked, which we know are big ones.
It's interesting. I guess it's like surge pricing, but choice.
Yeah.
Surge pricing.
Exactly. Now we're starting to see it more and more. But if you look at other businesses, other markets where it's relatively low margin, high volume stuff, like airlines, right? Hotels, right? There's a limit in how much you can make on that, little oscillations on the price of that airline ticket. But if you can sell the premium seat, or you can sell loyalty and rewards, and you can get them refundable tickets and faster access to the faster boarding lanes, people will pay a premium for that. And it turns out that a huge chunk of their revenue comes from those things.
Yeah.
So I would love to see people paying for reservations, paying for, faster charges, paying to skip the line of people, right? These are all, of course, there's other things we have to figure out, but these are the levers that make these very viable businesses at scale that we're not seeing yet in EV charging.
Yeah. Yeah.
Or can it stay kind of nice and innocent, I guess, a little bit, not like the airlines, because you're like, God damn, these airlines are screwing me. It's at least I know my CPO, they're just going to give it to me straight, 50 cents every time, no problem. They're not optimizing. That's just what they're going to give it to me for.
Also, they're also super constrained, right? When you pay for Sasco, you get an extra inch of leg room and you're kind of closer to the front.
We only have so much space on a plane here, guys.
Your seat reclines one more degree back.
Yeah,
exactly.
Yeah. Good. Well, Rohan, this has been a real pleasure. Thank you for joining us.
Yeah, it's been fantastic. Thank you very much for sharing all your experience, and also find it really interesting, the founding story of Stable and how you've kind of gotten into the space where you are now. And I guess maybe soon you'll be dusting off the autonomous charging arms as robotaxis and all the rest start coming onto the road.
Come full circle.
It's been a wild ride, but there's so much more to come. Thank you guys so much for having me. It was great.
Cool. Thank you, Rohan.
Thank you.